Hello, my name is Sean McKee, practice leader for KPMG's Public Investment Management practice and co-chair of the AICPA task force responsible for developing a new accounting and valuation guide. The guide's official title is the Accounting and Valuation Guide for Portfolio Company Investments of Venture Capital and Private Equity Funds and Other Investment Companies. Since that's a mouthful, we will just refer to it as the guide throughout this discussion. I am joined today by my KPMG colleagues, Brian Bouchard, Fred Betts, and Ted Hollow. Thank you, gentlemen. So one of the concepts we'll start out talking about that's foundational to valuation and is often discussed in the guide is calibration. Brian, I know you have expertise in this area. How would you define calibration, and why is it such an important concept?
So calibration is the process of using implied assumptions for observed market transaction as a starting point for valuations in subsequent periods, assuming that transaction is at fair value. So calibration is important because it aligns your valuation with actual market activity and facilitates subsequent fair value measurement.
So is calibration something new?
No, it's not new. It's just underused. It's actually covered in FASB's topic 820 on fair value measurement.
Great. So how does the guide emphasize calibration?
There's a whole chapter in the guide dedicated to calibration, as well as a section in the frequently asked questions. In addition, there's some great case studies in the appendix that demonstrate calibration, both in the initial valuation period as well as subsequent periods.
So, Fred, it seems like the guide is moving away from a traditional view of control and marketability. Can you tell us kind of how the guide talks about control and informs us in terms of how to think about it in today's environment?
That's right, Sean. Applying control premiums has been pervasive in valuation. However, the guide points out that applying a benchmark control premium without considering whether it calibrates to an initial fair value transaction is probably not appropriate in valuing private equity and venture capital investments. The guide discusses that the value of the enterprise used in valuing the instrument held by the fund should reflect assumptions consistent with the company's plans under current ownership and current control in a way that investors who have control would maximize value. In other words, the company will produce cash flows that are consistent with its current ownership and control, with the benefits of control baked in. Owners of other instruments in the capital structure would also benefit from these cash flows and the benefits to the business, whether they have control or not.
Great. So can you give me an example of how that works?
Sure. Let's do a simple example. Think about two unaffiliated funds, Fund Fred and Fund Ted. We'll use it in our example. Fund Fred's is super successful, cool, hip fund. Fund Ted is maybe the opposite. So Funds Fred and Ted negotiate with Arkham Enterprises to purchase all of Arkham's outstanding stock for $10 per share. The Cool Fred fund buys 60%, and the Ted fund buys 40%. And they both paid the same price per share in the transaction. As Fred has control, but we paid the same price, there's no evidence of a control premium in the transaction. And thus, at subsequent dates, applying a control premium to Fred shares would not make sense and would lead to a nonsensical result. And by the same token, applying a discount to Ted shares would lead to a similar nonsensical result.
So it sounds like I kind of heard some concepts that Brian was talking about around calibration. Can you kind of tease out calibration, how you use that to help you think about control?
Yeah, sure. So calibration allows you to consider how much was paid in a fair value market transaction and consider what factors drove to that price, including kind of the forecasted growth of the business, profitability, risk factors under current control. And it means that those factors are captured in the valuation methodologies from the get-go. So whether that's in the forecasted cash flows, the discount rate, etc. So going back to our previous example, Fred and Ted probably had alignment with how to run the business or understanding of how the business would be run under Fred's control and the associated cash flows with that situation.
So we've talked about control, and you've helped illustrate how I should think about it and how calibration works. What about marketability?
So marketability is a different concept, but we can apply many of the same principles in considering it. So we would think about how the cash flows are affected by marketability And we can also apply calibration as a tool in assessing marketability at a measurement date.
So the guide does a good job of walking through how to value equity in simple capital structures, which is pretty easy. If you figure out the equity value and you know you own a percentage, you just take your pro rata percentage and that gives you your value. However, many funds invest in portfolio companies that have complex capital structures, things that have multiple classes of equity, different series of preferred shares, common stock, options, or warrants. Ted, talk to us a little bit about how the guide tells us to think about how to value those investments when you have a portfolio company that has a complex capital structure.
So Chapter 8 of the guide has a nice flowchart and discussion around evaluating the different approaches that you might use. If you go back to our prior example where the alleged super cool Fred fund has control, or a liquidity event is imminent, it might be appropriate to use a current value method or waterfall. But if the liquidity event's not imminent or you have a minority interest, you may need to look back to the flowchart and evaluate some other alternative approaches.
What types of securities are considered in that flow chart that you mentioned?
All right, so the flow chart thinks about the securities you most commonly see in private equity or venture capital, such as common options, warrants, common stock, or different types of preferred, like you have your participating, non-participating, convertible, or non.
So let's start with the warrants or options. What does it tell me to think about the warrants?
Sure. With warrants, warrants and options are economically similar, so it asks you to evaluate them using a methodology that's appropriate for options and look at the capital structure and the different exit scenarios that investment might face and choose the appropriate methodology.
And if I move kind of further down in the capital structure in the flow chart and I think about what if I have participating preferred stock, how should I think about that?
Well, first, it says to use the yield method to value the liquidation preference, looking at the time to exit and the different exit scenarios. Then it says you value the remaining upside using one of several approaches. You can look at the scenario approach or the option pricing method or a hybrid of those two.
And Brian, if I have preferred stock, it's convertible, but it's not participating. How does the flow chart and the guide tell me to think about that?
Sure. It first asks you whether the preferred stock is highly likely to convert. If the answer to that is yes, then you can consider methodologies such as a simplified scenario analysis, full scenario analysis, or a hybrid method. If the answer is the security is not likely to convert, then you need to then ask yourself, are the outcomes bimodal in nature, meaning you get nothing or you get something? If the outcomes are bimodal, you can use an approach similar to as you would under a likely to convert scenario. If the outcomes are not bimodal in nature, meaning there's value to the liquidation preference under a low exit scenario, then you can consider a more forward-looking methodology, such as a relative value scenario analysis, full scenario analysis, option pricing method, or a hybrid method.
Are there any items in the guide that you think could alter current practice?
Well, one item in the guide that can be altered in practice is the use of the option pricing methodology. In certain circumstances, the option pricing method can be very helpful in determining fair value. But in other situations, it can yield results that are unreasonable or require significant adjustments to make those results reasonable. Chapter 8 covers such scenarios. But one thing's for certain, the option pricing methodology is not always a bulletproof method to allocating value across the classes of equity.
Good to know. I'd like to thank Brian, Fred, and Ted for today's discussion, as well as our audience for their time. The full guide is available on the AICPA website. KPMG is here to help you with any questions about how the guide may impact your business. Please feel free to reach out to me, Brian, Fred, or Ted with any questions, or any one of our KPMG professionals. Thank you.